Welcome to this week's The Point with Stephen Whiting and David Balin here in New York and Bedford. And today's point is called Straight to Earnings Season, which of course combines the two big pieces of news that we're going to be dealing with on today's program, which are the events in the Iran war and hopefully the reopening of the Strait of Hormuz, and the fact that we're about to begin earnings season. And these things are happening at the same time. The news of the week actually is good to some degree. It's very difficult to actually process this from both the U.S. and global perspective, but President Trump actually announced a ceasefire for 2 weeks, hopefully allowing the opening of the Strait of Hormuz again. Stephen's going to talk a lot about the fact that one of the things we're doing right now is tracking whether or not there is, in fact, an increase of trade through the straits. And we're going to talk about whether or not there's going to be a lasting truce and what that means for all of the Middle East and especially the movement of energy through that strait. And with all of this confirmation, one of the things that we're going to talk about is the need to actually not pay as much attention to the headlines and to pay attention to what actually is happening in terms of a return to normalcy of trade around the world. The market reaction, of course, to the ceasefire was very, very strong. But what was more interesting was the actual change in the dynamics of the oil market in terms of what futures prices were before and after the event. And what's really interesting, and Stephen will talk about this as well, is that oil for futures delivery is just $6 more per barrel than it was prior to the conflict. What does that tell us about what's going to happen and a return to normalcy in terms of the global economy? Now, we believe at the moment that energy shortages have not lasted long enough to have severe damage to the world economic outlook. But that doesn't mean that we are in the all clear zone. There are other outcomes besides a peaceful reopening of the strait. And for the most part, we should be talking about the forthcoming earnings for the next quarter to take a look at how they have or haven't impacted different parts of the economy. There are very, very big contradictions in performance when we take a look at U.S. technology shares or energy shares, or for that matter, what's happening across industrials. And a lot of that is important for how we go about building portfolios. But what we hope to show you today is that one of the reasons we have to use minds, not models, is to think beyond the conflict, to actually take a look at what the economy is likely to return to after a very, very difficult shock that the world has just endured. So with that, Stephen, let's turn it over to you and have a little bit of a conversation, if we can, about what is actually going on with oil and ultimately with earnings. So let's move to the next slide.
So let's just talk a little bit about what happened in markets. We had confirmation from Iran that there would be a 2-week ceasefire, that there would be a pause in hostilities, and the oil price plunged 17% across different products, different exact amounts. We saw that the most sensitive areas of the world had incredible rallies. Japan, Europe, 5% each equity rallies. And the oil market doesn't do this if it were some long-term supply damage and, hey, the bombs have stopped. It's really about transportation. It's that there is oil that is shut in the Persian Gulf that the world needs. So the story right now is very much watching whether or not the bombs stopping for a couple of weeks. And that's what the story of the day is. But really whether or not the Straits of Hormuz are an Iranian toll road, or whether or not they will really allow all of the goods that need to be transported. And it's not just oil, it's gas, it's obviously fertilizers, lots of things, whether all of this will be allowed to move. And that's the question of the moment. That's why there's some skepticism. That's why oil has bounced back 5% this morning. So we'll be looking at tracking data such as this. There's a lot of things going on that can't be tracked perfectly, dark ships, etc. But we really need a little bit of confirmation that the Persian Gulf and the Gulf of Oman, that we're going to allow trade to move. And that's really critical. So certainly it's good news that there are negotiations and that it's not just locked in. But I think we need a little skepticism in markets to see whether or not global trade will really be allowed to move. Then if we just turn to the next page, why is this so important? Hopefully someday we can sort of forget about this horrible event. But right now, the correlations between asset prices and oil. We're talking about bonds, stocks everywhere in the world. The oil price has been determining about 50% of the movement of every asset price in the world because these movements are so big. And so there you can see what a 15% decline in the oil price means. It means a 5% rally in Eurozone shares day to day. So not a normal environment. When there's more comfort that there will be normalized trade, you can see what you actually have on the next page. When you think about what happened yesterday, markets have always been expecting this to be just a transportation issue. The oil futures prices, as David mentioned, are $6 above where they were prior to the strike. When you think for oil for delivery a year from now, hey, we've got to get the Straits unblocked. So yesterday's move just accelerated it. Said, hey, this is going to be much, much faster. But there could be some skepticism here, and there are some military risks that you might want to talk about now, David.
Yeah, so I also wanted to mention, Stephen, that when we think about where we were before the war, we always talked about the plentiful nature of oil supplies around the
Right.
world. We turn, the adequate supply and actually, the ability to go out a year or even 2 years, right, and get, more than enough supply. And it looks like, the markets are expecting that we'll get that again. And I think that's important. But the military risks that, Stephen, we're talking about are significant because in the event that there isn't a successful negotiation, it is possible, and the U.S. certainly has the ability to take Karg Island, for example, as a means of negotiating with the Iranians in the event that these are unsuccessful talks. That would be, I think, a 6-month extension and a very different outlook for the world. In the event, for example, that Iran actually starts a toll road, meaning that the U.S. is not policing the strait to the same degree, and the Iranians actually need to set agreements with different people for rights of passage, that would be a big change in the way that the straits actually operate. But the net effect of having them reopened or not reopened is, in fact, going to be the deciding issue. The reopening of the straits will actually allow the global economy to move ahead. And if it does, we think it will return to where it was before, obviously with a material delay in the global growth story that we had expected on January 1st of this year. Let's go to the next slide.
Yeah, I would just say that it would be a dent in the current year. There's no way that a couple months of extremely high inflation, when I'm talking about a supply curtailment, prices are higher, incomes aren't, that's going to take a dent out of this year a little bit. You move out a couple months, if there was a normalization of trade, most by far of all of that will be made up. Now, just to talk about earnings season, we're right on the cusp. And if the outlook is darkening for the world, you'll see CEOs talk about, well, we're unsure about where the world will go. They're going to say that anyway. But if this event were passed, they'll probably talk about how they'll be able to normalize. And there might have been some costs in the current quarter. I doubt that the software makers are going to talk about oil, but the kind of thing is there are many, many companies that are going to be affected. Now, you saw that picture just before that showed that the futures price of oil goes down. Well, analysts rightly assume that the earnings growth rate for commodity producers that are oil producers, those will be going down too. So you can see this chart shows how shares have jumped somewhat more than earnings estimates for the quarter that we're just ending. Earnings beats are likely to come in here, if not right in the 1Q window, in the 2Q window. But if the oil price comes down, none of that is like a long-term growth rate. Now, this is one of the reasons why, again, we've held one position that was really energy intensive, and that's really the infrastructure of energy, shipments of natural gas from the US to others. And of course, those will fall a little bit too when the price of oil comes down. But the reality is that we're sitting here with near an 8% yield compared to 2.5% for energy. Energy is neutral. Master limited partnerships, energy partnerships, those are our overweight.
That's right. And I think we should talk a little bit about the fact that, this war did send a signal to the world. So if you think about what's going on now with energy demand associated with AI, when you think about the reliance, right, on oil and other fossil fuels, that has not changed. What has changed is the world's attitude, I think now, realizing that this risk is a bigger risk than they expected. And so one would see more demand, right, for nuclear energy, for nuclear fuels, for different supply chains associated with fertilizer. And there are companies all over the world that are beneficiaries of this shock that are going to see, I think, a second phase of interest on the part of shareholders and investors because of the fact that they're now going to have more intensive interest in the businesses that they have as a substitute, right, or a way of actually accelerating, I think, the substitution impacts associated with the reliance on this strait for their businesses and for their economies.
I
So,
think energy supply diversification is a winner from this,
yep,
regardless if there's too much oil, that, these supply chain risks are going to probably make, if you're going to be on the margin, investing in electrification, right, of
exactly.
vehicles, which is done really bad, at the margin, you're going to be moving that needle up some. Well, we go to the next page. Just talk about some of these other big, exciting sectors. And you can see on the left, for example, that the earnings in the technology sector, and again, we're rolling it all up here so we don't show you 90 charts, the earnings are stronger than the share prices have been. Technology is down 4.5% year to date, even after yesterday. If you take a look, this year's supposed to be a 41% EPS growth rate. Now, that is driven by semiconductors up 88%. That seems like a massive leap from profitability, but it is what you get when AI infrastructure spending, the revenue growth is more than 50%. You have to think about that as the margins are more volatile than revenues. You're likely to see just excess demand for chips, for memory, for all of these things in the coming year. That's not the long-term growth rate either, but you can see that the share prices have paused here, unlike some others. Healthcare is interesting because the estimates for the current quarter are really weak. The share prices have been weak. And this is not, again, a sector that's in a boom like semiconductors. There's nothing else like that. But where you can expect double-digit EPS growth is the expectation. If we were to deliver it from these share prices, it would be a good outlook for the healthcare sector.
What's been very interesting, Stephen, is that I've been reading now that 50% of the power delivery for data centers is being delayed, and that the ability to actually build the data centers, given the level of demand, is now causing delays. And one of the things we're going to have to adjust in our outlook is, that the growth rate may slow, right, but it may be over an extended period of time, simply because they simply cannot meet the demand for both energy and data centers that are going on there. And I would also point out for this week that we saw, Anthropic report, just to give you an idea, a $6 billion quarter-over-quarter change in revenue associated with AI usage, right, and tokens that have been purchased by corporations adopting AI. We're seeing an extremely fast adoption of that technology by companies, and we think that is going to continue. So this is a major change, and we're going to be looking at the ability for the U.S. To deliver, right, on the promises of the build-out of the AI infrastructure in terms of data centers and energy, and the impact that that will have on markets. But the larger point that Stephen was making is it's that when we looked at this quarter and when we actually think about what we did, we added some exposure, right, to REITs, and we added some exposure to MLPs. We did not sell anything during this quarter, during the change that went on due to the war in Iran, because we had to make the decision to look beyond that war in terms of where portfolios were going to potentially go when its resolution occurred. And this is an important part of our consideration now in terms of deciding what is to remain or grow within our portfolios. Next slide.
So let me go to that issue you just talked about with, building the AI infrastructure. This is definitely a positive for the industrial sector. And if you take a look at electrical equipment maker shares, they're up 80% over the last 12 months. Earnings are going to be very strong in that area, but you also just see construction machinery and like agricultural machinery. Like those types of companies have had a performance that's been nearly as strong. And so you can see the black line has been stronger than the earnings estimates. I'm not quite sure that the earnings estimates for all of these companies are really going to jump. Now, this is a big sector. Again, can't show you 90 charts. Obviously, the transportation companies like airlines that are stuck in this sector have been dented in the current quarter. If the outlook is clear for this war and the oil prices dropping, they'll make sure to note that in their outlook, and their share prices have dropped some. But there's probably a reasonable amount of enthusiasm that we're moving right on to broader economic recovery, something we think is possible, but it's more in the share prices already in many of these industrials. Financials have dipped. Please.
No, I was going to say the financial sector is very interesting because it has, real impacts from how investor sentiment goes. And this is an area where, even though we saw good performance in 2025, right now we sort of see a lull in those shares. But it looks to me, given all of the factors that we've got, that we should see some earnings surprises there, Stephen, right?
Yeah, I would think that, again, for the large capital market sensitive banks, there's going to be upward surprises. And, it will be very sentiment driven. Again, in the outlook, if the outlook is that this war has a finite endpoint and they report positive surprises, they will rally on that in every likelihood in my mind. To me, if the outlook were weak and they reported positive surprises. In other words, if there was concerns about spillover private credit to broad banking, if there's a concern that the oil price problem is 6 months, like we said, Carg Island, they're going to have a lot of trouble. They're going to be very driven by a higher beta version of the market performance itself.
We are concerned about private credit. We think that there is a very interesting sort of wall of refinancings that is going to take place, and that will be a second concern. And obviously, there's been a lot written about the concept of a spillover between the private credit struggles right now and banks. But when we take a look at the actual data of bank exposure, major bank exposure to private credit, it actually is indirect and mostly to the funds and companies that are sponsoring these. And so we do expect there to be some stress there, and we will be monitoring that. But the private credit situation itself, actually, and financials are not currently causing a trading difficulty for the major banks. Next slide, please.
So I'll talk a little bit about interest rates. And, it's very true. We said the oil price is determining 50% of the variation in the world's asset prices. It's included bonds. That this was an inflationary shock. It's not that the Fed printed more money, they were on hold. It was that the supply potential of the world economy is reduced by the transportation bottleneck. So as an inflationary shock, markets were not entirely willing to look through it. Bond yields rose about 40 basis points across the world, across government bonds and private markets. They did not take a terribly pessimistic view of the future of the economy, which might have made the government bond market rally and things like high yield issuers suffer even more. It was very proportional. What I think is good here to see is that these debt capital costs are really not rising further. It's made the bond market a little bit more attractive. It's meant that the market has taken Fed easing off the table for the year, even as the Federal Reserve still has modest couple of easing steps in their outlook. And they're never telling you that rates are going to plunge. So here's the thing. When we get past this shock, if the labor market weakness, which takes time to really play out, improvements are going to take a couple of years to play out, it's very likely on our view that the Federal Reserve is going to return to its modest easing cycle. It's going to try to create some accommodation out there if the inflation rate does come down. That will be really in the hands of the Straits of Hormuz.
That's correct. But this is why, when you look at the CIO Group portfolios, we have a full weighting, right, to interest paying bonds. They're attractive, right? They give you a good cushion in the diversification score. And again, it's an area where I think people are not paying enough attention to what is available. Stephen, I do have one question, I think, regarding the ability for the debt capital markets, right, to substitute for private credit. Is there enough capacity, right, to actually see some of the people using private credit to return to public markets?
I think that that's marginal. That you can see, the private credit market has not been it's been the better deal for yield for the investor. It's been wonderful for middle markets companies that are not public and not providing all of the disclosures that you would see in a bond indenture, or even going to banks for a loan entirely. So the reality is, I think a lot of those companies would transition. The bulk of that market can't just transition to, let's say, the high yield bond and loan market. Those are good standards. We see good standards for high yield loans and bonds, especially the bond market. I think a high yield bond is very, very close to an investment grade instrument for the most part. Now, again, some of the companies are cyclical and they do go south. But the reality is it's a different market. And I think you can only see a modest amount of substitution.
That's great. So thank you for that. Let's go to the next slide. So this is our only "we told you so" slide. We don't like to say "we told you so," even though it is kind of fun. But the more important point that we're making is that our current outlook, and again, it's sort of an 8 out of 10, 9 out of 10 thing, is that we're going to have a return right to a different growth rate and trajectory for this year, but that growth will be maintained because of the fact that the war will hopefully have ended through a ceasefire and some negotiations that leave us with the straits open. But the point that Stephen's made in, I think, the last four of our six broadcasts is that rarely does an event like this change the direction of the world economy. And it's this type of thinking, I think, that people underestimate. Because when you try to trade a war, when you actually try to buy and sell things during that, anticipating whether or not it's going to be a big shock or a small shock, you actually waste a lot of time and you end up hurting your portfolio. By taking this literally and taking a look at what markets have done 30 days and 90 days post crises, you'll see that the vast amount of time there's a material and sustained change, positive change in markets. And we'll see what happens, of course, over the next month or two. But Stephen, this is not one of those events, right, where we see a permanent supply shock at all, or in fact, a significant enough event like a world war, which would actually cause the economy to change direction completely.
So we know that there are scenarios, there are low probabilities that this is the powder keg that sets off another World War I type event. And those things exist on the margin. You just mentioned earlier the possibility that if we did have a ground invasion, because things don't go well in the next 2 weeks, this could be extended. But all of the probability suggests that this is not because of major economic imbalances. We didn't build housing as far as the eye could see that was never going to be sold, right? It's not one of those booms and busts. We have those issues below the surface to deal with. This is a shock. It just interrupts the economy temporarily. And if you're going to be making big asset allocation changes on that, let's remember you've got to be right twice. You've got to both buy, sell, get back in again. And that sort of thing is hard. Let me just go to the last page, and I just want us to think about one other element of all of this. There were a lot of tells from yesterday. It didn't mean whatever yesterday happened, we have to repeat this every day. It's certainly not happening today. But the dollar dropped over 1% yesterday on the announcement that there could be resumption of normal trade. That benefits a great deal of the rest of the world. That's because the US, again, it's a great deal of oil supply. Oil prices in the US have gone up as much as the rest of the world. It's a commodity, et cetera. But the big story here that we mentioned is that the Federal Reserve has been held up from possibly easing monetary policy. Now, that's not about this month, but in the futures curve, expectations of Fed easing came out. That strengthened the dollar. The rest of the world on a relative basis looked weaker because of the energy shock. If we unwind that, you take a look at that picture at the right, the inflation adjusted trade weighted dollar, that big cycle, 3 distinct cycles, we're 12% above average. Non-US equities have still outperformed in the year to date. It doesn't mean that we like their earnings growth better, that their valuations are going to equal the US, but the opportunity for global diversification has worked now for 15 months. In the prior 15 years, the US outperformed. There's a lot of exceptionalism priced in the US. We want to make sure that we don't exaggerate that in any extent. A lot of good going on AI that you can see on the left. It's certainly priced quite richly in the equity market.
Great. Well, thank you very much, Stephen. And for all of you who've joined us now during this crisis period, we thank you so much for attending the point. And we want to point out that there's going to be another great set of documents coming to your way this weekend. There'll be a broadcast next Thursday, and hopefully we will be talking much more about earnings and what is actually happening in the stock market, and a little bit less about a war that hopefully will be resolved shortly. Thank you for joining us, Stephen. Wish you a good day, and everybody, will see you next week.